Since 1990, I believe, implied volatility has overstated historical volatility like 83% of the days. So 83% of the days, selling volatility has been a profitable strategy. And so I think that's what we're really trying to get back is a way basically for LPs to be passive. And instead of doing that work of withdrawing liquidity by setting the range, we'll have hedgers and speculators doing that work and also pricing the volatility better so that on average, they'll come out ahead.
Hey everyone, welcome to the Edge Podcast. I'm DeFi Devin from Fourth Revolution Capital. I'm joined here by my co-host from 4RC Nomadic. Today, we're going to be trying a shorter format of the podcast called Quick Hits. This is where we spotlight new and upcoming projects and teams who often aren't live yet, but offer promising innovations for the DeFi and Web3 space. We'll help you get ahead and gain some edge on your peers by diving into what we believe are the most exciting developments in this space. But before we do, just a quick word from our sponsors who make the Edge podcast possible. Whether you're a trader, farmer, analyst, or newbie, you can trade smart with KYBERSWAP, the OG decentralized exchange and aggregator on 13 chains. Swap at the best rates, farm with real yields, set limit orders, use their proprietary trading and AI tools with the best UX in DeFi, securely and permissionlessly. Get better rates, better opportunities, better alpha, and a better trading experience. Trade smart now at KYBERSWAP.com. G-Trade by Gains Network is a decentralized leveraged trading platform allowing users to synthetically trade crypto, forex, stocks, and commodities with up to 1000x leverage. G-Trade is live on both Polygon and Arbitrum, with over 30 billion in all-time trading volume and nearly 50 million in vault liquidity. The platform has consistently been among the top earning protocols, with 7-figure monthly revenue and a net deflationary token. G-Trade has become an on-chain staple for both traders and yield seekers. Check them out at gains.trade or by searching Gains Network on Twitter. The future of Web3 is bright, but crypto startups, DAOs, and on-chain organizations can't scale without tooling to power world-class financial and payment operations. Introducing Utopia, your all-in-one platform to create, execute, and understand your Gnosis-safe transactions. Execute payroll 10x faster through automated payment plans. Coordinate reimbursements and accounts payable through payment requests. Execute multi-sig transactions faster with your global team through signing links. View, label, and categorize all of your safe transactions in one place. Start managing your on-chain payments today by going to utopialabs.com. To get started with gasless payments, message Utopia's co-founder on Twitter at 0xkaito. So to kick off today, we're interviewing the co-founder of a very new protocol yet to launch on mainnet called GammaSwap. It's been a talking point for some time that LPs and AMMs like Uniswap are potentially not compensated fairly for their risk. GammaSwap would tell us LPs are short volatility, but paid according to fees on trading volume, and that this is not optimal. So GammaSwap proposes fixing this by creating a two-sided market for volatility, enabling hedgers and speculators the ability to buy volatility from LPs. Given the demand for volatility in crypto is even larger, GammaSwap will attempt to increase returns for LPs with this new protocol, which we're going to talk all about today. So on that note, DeFi Devin, or Devin, welcome to the Edge. How are you doing?
Doing well. Yeah. Thank you for having me. Really excited to be on this podcast. I think you guys have had some amazing guests. And I've been following DeFi Dad on Twitter for a while now. So it's awesome to, I guess I've already put the name to the face, but actually be here and talk with you guys.
I love it. That's the way we should start every podcast. Just give us a bunch of flattering comments and we can dwell on how wonderful we are. No, thanks, Devin. That's really kind of you to say. And actually, it goes both ways here. Nomadic and I have been talking more recently, I'd say the last few months, about what is this GammaSwap thing? It looks really powerful as like a new primitive. And part of the reason we wanted to do this podcast is because we've both had this light bulb moment recently of how this all works. And so we're hoping to sort of dumb this down for folks so they can better understand how to potentially use GammaSwap in the future. So to start off, you've written a number of threads recently on what's wrong with liquidity provisions on AMMs. Can we first talk about that? Like, could you dumb down what you mean by Uniswap is an options market describing itself as a DEX?
Yeah, so no, I think AMMs were a huge innovation, right? So originally people were trying to do, originally they were just centralized exchanges, which are great, but you have to actually, choose who you're adding all the assets for. And yeah, there's some centralization risk there and risk of holding your assets there, not your keys, not your coins. Mt. Gox was terrible for a lot of people. And so there became this kind of interest in building something, decentralized, which I think is what we're all aiming for. EtherDelta, was the first of its kind, but the problem, especially if you're building something on mainnet like that before, was the latency was super high. It was hard to get liquidity because it was so costly for people to update these orders and market make. And so, yeah, I think it was Vitalik originally proposed like an AMM model that had been used in prediction markets before, but actually applying it to a spot market, to token swaps. And so there are a few implementations. Uniswap became the most successful because they had this really easy, passive product to provide liquidity into. These composable LP tokens, these ERC20 tokens that were used, in all these other contracts and really helped, ignite DeFi summer. And now as, more liquidity has basically been provided in these AMMs, we've noticed some scalability issues where, when a pool has enough liquidity, that the fees don't actually scale to provide necessarily enough returns for the risks that they're taking. It's almost, it's hindering the amount of liquidity available in DeFi. So the solution Uniswap v3 proposed was actually a way to leverage that liquidity by being more capital efficient and essentially selecting a certain range, which, I guess you would need, you get less slippage because you have virtual liquidity for that range. But our position is that it introduces some other problems. I don't think order book-based AMMs are going away, but I think it particularly is something that doesn't necessarily work for new projects. And, in our mind, the best way to increase DeFi is making, products that are really easy to understand and for retail to access. And so I think order book-based AMMs are an interesting application, but I think it's actually crowded out retail a lot from market making. And as we've seen from, a lot of the data, I think Alex, Dicky Thought on Twitter has posted some actual June boards on this, is that, the majority of LPs are actually unprofitable, even in these order book-based AMMs that are essentially more capital efficient, which capital efficiency is just a euphemism for leverage. So they're leveraging, it's basically Uni v2 with leverage. There's some cool things you can do with limit orders, but it's not actually solving the way we see it as the critical problems of AMMs, which is that LPs are basically selling options. They're not like typical options in the sense that there's no expiration. The delta in a normal option is capped at 100, while the delta in AMM actually can go to infinity. There's no theta time risk, and then you're paid in trading fees, which actually isn't like necessarily a premium. And so that's our thesis actually, is that, fees are competed to zero. We've seen L2s and CK Sync competing that to zero, of course, using the mainnet security of Ethereum. But now we've seen Arbitrum actually at times, have more transactions than Ethereum. So competing those gas fees to zero, all L1s. DEX fees are being competed to zero with order book-based AMMs. It used to be, on average 0.3%, and now a lot of the pools are lower. So all these fees are competed to zero. And if you're compensating LPs with trading fees, not only is that hindering the ability of DeFi to scale, but it's also, it's never going to be competitive with centralized exchanges, which, already have more liquidity and typically charge maybe not all clients, but especially clients that are doing any considerable volume, basically no fees.
Awesome. So Devin, like what is the solution that GammaSwap's providing, and I guess what is your strategy for kind of curbing and solving for IL, impermanent loss, without like somebody else holding the bag?
Yeah, no, it's a good question. I mean, I think impermanent loss is never going to go away, right? There's no free lunch. So if there's no risk that you're taking, you can expect a risk-free rate of return, somewhere like treasury bonds, but you can't expect, any, alpha on top of that. So there has to be some risk that's taken. So we're not necessarily removing impermanent loss, but we're essentially allowing people to buy insurance on that impermanent loss. Like that was the reason derivatives came, in the first place. It was a way for farmers, to basically lock in a price at a certain expiration for maybe their commodities. That's how futures markets started. And now derivatives volume has actually exceeded spot volume. And a lot of that is for people to buy volatility and hedge any volatility in the spot markets or writing these options. And so, yeah, that's actually something that's really cool about derivatives now. So since 1990, I believe, implied volatility has overstated historical volatility 83% of the days. So 83% of the days, selling volatility has been a profitable strategy. And LPs and AMMs are selling volatility, but aren't that profitable. So our thought is, okay, if we allow people to buy volatility from those AMMs, because it's so cheap if you were able to actually take the opposite side of that trade, then it would price the volatility better and compensate the LPs better. And so that's in TradeFi, but we've seen demand for volatility be even higher in crypto. Like GMX has done very, very well because they have this really passive LP product, and essentially those LPs, it's not an AMM, it's a contract for difference platform, but their fees are dependent on basically the perp traders buying volatility. They're not, it's a different type of basically option because your leverage is locked in, but you're essentially betting that volatility is going to be high, otherwise you wouldn't buy a perp. And so they're being compensated by these people buying volatility and have been able, on average to have a really, high return in a passive way. And so I think that's what we're really trying to get back is a way basically for LPs to be passive. And instead of doing that work of withdrawing liquidity by setting the range, we'll have hedgers and speculators doing that work and also pricing the volatility better so that on average, they'll come out ahead. They may not always be profitable. I don't think that's possible necessarily with any product, but they'll be better compensated for the risks that they're taking because our first product is actually this ability to borrow liquidity from the AMMs. So let's say you're providing liquidity into a SushiSwap ETH USDC pool. You would earn all those fees from the ETH and USDC as an LP, but now you also earn additional borrow fees. So in periods of higher IL, there should be more demand to borrow liquidity since it'll be more profitable. So you may not come out ahead necessarily, but you'll be better compensated for that IL risk that you're taking, or maybe even coming out ahead depending on the market dynamics.
This might actually be a good time for us to start to talk through some of the mock-ups you have for what will be the user interface once this goes live on mainnet. Devin, would you be comfortable starting to screen share and we can kind of talk through some of the questions?
Yeah, sounds good. So we just released a closed beta for DGen score holders. So that testnet, there's some optimizations we're doing. So we'll show that testnet, kind of like a live demo, and then we'll also show some of the Figma designs we prepared. So we've been lucky to hire a great head of design. He was actually previously from CoinMarketCap and led some designers there.
As Devin is pulling this up for listeners, I'll describe what we're seeing on screen because the interface, even though I haven't seen it yet, I've imagined it to be fairly simple. I think one of the important things to understand about this is if you are holding an LP, let's say in like a Uniswap V2, when you hold that, you are short volatility. Like you are going to do best when you earn from trading fees, which trading fees tend to go up, I think, with volatility. And so this is the problem that GammaSwap is solving for. When you are holding those two tokens in like a 50-50 ratio in something like Uniswap V2, you will do better than by earning off of increased trading volume. But you would hope that the prices will remain stable so that you can basically withdraw with the exact same amounts. Here, as we pull up GammaSwap, we're looking to capitalize on the fact that there are folks out there who would like to be able to basically borrow those tokens or that LP, and that helps to create this sort of marketplace that GammaSwap's enabling.
Yeah, I would say just to add to that, so we did some backtesting on the correlation between volatility and volume in Uniswap. On average, it's around 50%, but some days it was as low as 10%. And so, of course, the correlation between volatility and volatility is 1-to-1. So we just feel like it'll be a better way to scale DeFi liquidity because, yeah, if there's more liquidity being provided in the pool, then the APY lowers, and then it's more profitable to borrow liquidity. And then vice versa, if maybe people are borrowing liquidity, then more people provide liquidity. So they're just taking that volatility bet, and it should be, it should be something that could scale much higher because, yeah, with the fees, if it's not 100% correlated, as the pool becomes more popular, the volatility risk that you're taking is a little bit lower because the market's more liquid, but there's still significant volatility risks while the fees are being spread across so many people and maybe hasn't grown at the same scale. So then it becomes much more difficult to actually adequately compensate LPs with those fees.
Makes sense. And for folks that are listening, we'll share this on YouTube and LensTube, but we're looking at an interface that really looks like a perps trading interface. And, I've got the options to either go long, short, or straddle.
No, I would say we had an alpha testnet back in January, and I guess we might reuse some of the UI for an advanced version, but basically I think that's a misconception people had an issue about GammaSwap was that, we were going to be this really institutional product that very sophisticated people would use to hedge IL, which is not really our belief, I suppose. Our belief is that, order book AMMs are interesting for certain use cases, but, for the long tail, not as useful because, the problem with order book based AMMs is that you're leveraging liquidity. And so the liquidity is really concentrated around a certain price, and then the price goes out of that. There's no liquidity. So it becomes really hard to swap. And then, of course, the LPs, take a lot of that loss. And so we saw that actually with the USDC debacle, UniV3, all the USDC DT was drained from the pool. And then Curve and UniV2, there was still liquidity to actually swap with. And so a lot of new projects, because they're super volatile and less liquid, are still launching on these full range models because of that, not to wreck their LPs and also to always make sure there's liquidity to swap with. And I think it's also just a more retail friendly product. We want something where LPs can provide liquidity and still participate in market making and have that available to them. And so we think this is a model that could support the long tail and allow retail to not be crowded out of market making. So yeah, the original alpha version, you would basically provide the collateral and it would change the curve. And so it was, completely bare bones. Nothing was abstracted away. Now we let people basically choose the perpetual position they want. So they can choose a long, shorter straddle. They can provide collateral in either of the two tokens that are basically in the pool. And then what we do is we do all the heavy math and heavy lifting on behind the scenes. And when you actually take this position, we'll have that collateral. We redeem the LP tokens that position's worth based on the capital efficiency. It's essentially leverage. The problem is that it's not like a future. So in a future, it's a Delta 1 product. If you pick 50x leverage, no matter what happens to the price, you'll always have 50x leverage. In this, since it's the opposite of an AMM, the delta is changing throughout the curve. So actually, as the price moves farther away, you get more leverage. So it could be anything, if you were to choose 97% LTV, it could basically be starting at 5x leverage and then go all the way to 20x, and in new models could even be higher. But it's basically a capital efficiency. And then there's a liquidation LTV. So let's say you choose a position that's 97%, that's the most leverage, the most liquidity available. But yeah, you might be closer to liquidation versus, something where you did like an LTV ratio that was much smaller. You wouldn't get as much leverage, but you could hedge maybe your permanent loss for a long period of time or hold that position for a long period of time. So there's an interest rate basically that's based on the amount of LP fees and the utilization. And you would be able to see the opening fees and that basically that APY here. And then you could calculate, whether you want to open that position. So we'll probably want to have calculators and stuff like that to make it simple. But maybe, you think ETH is going to substantially rise in price over the next 2 weeks. And the APY is, let's say it's like 10%. There's going to be a spread between the supply APY and the borrow APY. But let's say it's like 10%. Then that means, let's see. So yeah, that would be maybe like 20 basis points around that per week. And so you could choose a position with let's say it's 97% LTV and get liquidated 98%. So you could hold that position for a month, maybe longer. Obviously, some of the APYs might get pretty crazy, especially for altcoins that are super volatile, but that's how someone could measure their position. And so, okay, is the returns from this position, going to basically be higher than the interest rate that I'm paying? And that's the calculations people can do. But the cool thing is that, unlike a perp, let's say you were to do a call, if the price moved up 100% in this, you might have like a 5 to 10x return on that. Versus a perp, you could get more leverage. But if the price moved against you in like a perp, you'd get liquidated. Versus this, even in like a call, if the price moved against you 100%, you'd actually be up 10%. It's only if there's no volatility and the interest rate eats up your collateral that you get liquidated. But you basically have like covered calls, puts, and straddles, perpetual on any token permissionlessly. So you could basically get leverage on any token in DeFi.
Devin, can we talk through a few examples here? So if you zoom back out just so you can see the whole screen. So in this case, we're referring to the LP that is ETH USDC. If I'm someone who's holding that LP, ETH USDC, how do I participate here? What would I be likely to want to do here? Long, short, straddle?
Yeah, so if you were providing liquidity, that would be like an earn screen. These are the people like borrowing liquidity. So if you wanted to provide liquidity, you could choose the AMM. So it'd be like Uniswap, SushiSwap, or Balancer. You could see the TVL, the APY, and then just decide to provide liquidity. And like the full range models, you would just provide liquidity throughout the range. And that it's as simple as that. So you can choose your favorite AMM or maybe even arbitrage APYs.
This makes sense. So if I'm an LP, I'm going to probably focus on the earn tab, and I'm earning this additional yield then from folks who are ultimately borrowing that liquidity, right?
Right, yeah. So you would earn, so all the liquidity that's provided through here for our first product is actually provided in the underlying AMM. So at minimum, it's equal to the yield if no one was borrowing liquidity of that AMM, because you're just earning the swap fees. But then if anyone's borrowing liquidity, you're earning those additional fees that they're paying to borrow through the interest rate that they're being charged. So you'll earn extra fees, basically based on utilization.
So let's say I'm holding the ETH USDC LP. I now deposit it into the Earn tab in the GammaSwap UI, and there's other folks that are potentially borrowing that liquidity to create different types of positions. What happens under the hood? Is my LP still intact, or is it possible that you would ever withdraw that liquidity from the LP, that GammaSwap under the hood would have to withdraw it or swap it into different tokens?
Yeah, so the way we do it, so let's say it's the Uniswap ETH USDC pool. You could provide liquidity either with your Uniswap LP tokens, if you're already providing liquidity, or with ETH or USDC as tokens. And essentially, if it's the ETH and USDC, we would provide that liquidity in Uniswap. We would hold on to the Uniswap LP tokens in our smart contract, and then we would issue the LP GammaSwap LP tokens representing that AMM and that token pair. So it collects all those swap fees plus additional borrow fees. And then when someone wants to borrow liquidity, they would provide collateral in either ETH or USDC. They would open that position, and basically based on their LTV, we would burn a certain amount of those LP tokens for the underlying tokens. And we hold on to all those in the platform. So if there's any volatility, that ETH and USDC is more LP tokens. So that's where the impermanent loss is turned into the impermanent gain. But we actually, we withdraw that from the underlying AMM. So there's potential for the platform to actually have more liquidity withdrawn than is actually being provided through GammaSwap. So we basically, with our interest rate and variable opening fees, have ways to prevent the platform from being over leveraged. But you can never withdraw more liquidity than is available in the underlying AMM.
So Devin, just from like listening to this, if the minimum that a GammaSwap LP can earn is that base APY in, say, the Uniswap, balance or sushi pool, does it not make sense for like almost everyone to utilize this to try and enhance that APY?
Yeah, well, yes and no. So I would say an exception might be if you're earning liquidity incentives on the underlying LP tokens and not the GammaSwap LP tokens. It could be that those token incentives are higher than the additional APY that GammaSwap is offering through the borrow fees. And then, there's also additional smart contract risks that you're taking by providing liquidity through GammaSwap. We've been audited by Halburn. That's been successful. And now we're getting our balancer integration and other mechanisms audited by Zelic. So we're mitigating that risk, but that's always a risk you take when interacting with DeFi. So those may be reasons, but I guess the economic model, there isn't any additional risks that the LPs are incurring by providing liquidity through GammaSwap.
Good points there. And just to be clear, so I guess that boosted APY provided to GammaSwap LPs, is that paid out in like USDC or is that the Gamma token, which we should talk about a bit later?
Yeah, it depends. So if you're providing liquidity, it's going to be at the ratio of the LP tokens in terms of the liquidity provided, and then the additional fees, it could vary. It depends on basically how people are redeeming, or basically the collateral they're providing with these. So it might be slightly weighted to one side, but it should be pretty close to the ratio that you're actually providing liquidity into.
So Devin, what are the other risks to using GammaSwap? You noted, the universal sort of risk of smart contract risk whenever you use DeFi. But aside from that, let's assume that I'm earning in an LP like ETH DAI on Uniswap, and there's no LP rewards anywhere. So GammaSwap is the best place for me to potentially earn more to compensate the risk of impermanent loss. What's the other risks that I'm taking by using GammaSwap?
So as an LP, there is no additional risk. If you are borrowing liquidity, there is the risks of liquidation, of course. You can't get liquidated from a conventional flash loan because we're pricing it based on liquidity invariant, not the collateral. So that's how we're Oracle free. Someone could use a flash loan to try to manipulate the fees and the AMM to spike it, to liquidate maybe a large borrower. We also have mechanisms in place to prevent that, basically by capping the interest rate. So let's say the interest rate's capped at 1,000% and it's something like 97% LTV. It would still take about 24 hours to get liquidated. So we feel like that's enough time for people to close their position, or other people, because that APY would be really high, other people to provide liquidity. That actually wouldn't be through there's the flash loan. That would be that specific attack would be, if someone owned the majority of liquidity in the pool and was trying to manipulate you. So there are, otherwise there's typical AMM risks, which, someone could control the liquidity in the pool, rug you. So that's part of the problem with permissionless DeFi. So there's definitely risk for borrowers. For LPs, it's the same risks you would have in a normal AMM. Besides some of those other risks, there's no actual economic risks that's different from providing liquidity than a normal AMM.
To clarify too, when someone is borrowing the liquidity that I've deposited as an LP into GammaSwap, it's not like they're borrowing that LP and they can basically go off and do whatever they want with it, right? They're limited to certain actions here through this interface that's labeled trade on GammaSwap, right?
Exactly. So we have, all that collateral. So like when we withdraw burn the LP token for the underlying tokens, you can't like loop it like a traditional money market. All that collateral is locked into GammaSwap to prevent, bad debt or under collateralized like loans. So that's a difference between like maybe like a traditional borrowing platform. So you're limited to the actions available here.
Can you describe how GammaSwap integrates with the DEXs you've mentioned in your docs, such as Balancer, Sushi, Uniswap? How are those relationships formed? Like, is that like permissionless, like that you're integrating, or is this more of like you've reached out, you've talked to them? And then if you can share kind of like any other DEXs that are interested in partnering, that'd be great.
Yeah, great question. So the way GammaSwap works with these underlying DEXs is very synergistic. It's not like vampiring liquidity or anything like that. We actually, if this model works, we should be increasing liquidity in the underlying AMMs. So essentially, we basically are providing this extra yield to provide liquidity in Uniswap, SushiSwap, and Balancer. So, there should be an arbitrage opportunity based on, liquidity. If the APY is higher, you're taking the same risks in GammaSwap than you are the underlying AMM. And therefore, it's more profitable to provide liquidity at a higher TBL. There might still be some caps there based on like the way trading fees scale with volatility, but it's basically a way to help these AMMs like scale up their liquidity. And all the pool creation in GammaSwap will be permissionless. We're starting permission for the first month or two just to make sure the parameters on our opening fees and interest rates are working well. All the contracts in GammaSwap are non-upgradable, but we do have admin keys to make sure that the parameters are working well for these different models. So we will be doing that, and then once we're confident that it's working as intended, we'll allow permissionless pool creation through GammaSwap with the integrated AMMs. The AMMs that we integrate with, that requires integration work on our end. So our code is modular and can technically work with any AMM, but the parameters that we input have to change. So we basically have to build these integrations. Periphery smart contracts that would integrate with the core smart contracts, the factory. And so, it's working. So far, we're planning to integrate with Uniswap v2, SushiSwap v2, and Balancer v2. The Balancer, because of the weighting of the pools, requires next integration. And then, we can add integrations after that. So that won't be permissionless since it would require work on our end. But once we have the integration on our end, like the ability to interact with those smart contracts is of course permissionless. So we don't necessarily have to partner with the AMM. So we do, prefer to like be in contact. And SushiSwap is supporting us by providing some sushi tokens to some of our larger pools on Arbitrum. Balancers provide us a grant. So it seems like a lot of these AMMs have been excited to have a solution that could potentially increase the TVL or provide their users a way to hedge.
Awesome. And are you getting like any AMMs kind of reaching out to you directly?
Yeah, we've had a few. I think GammaSwap, there's probably going to be up to a certain amount of liquidity where it makes sense for us to build towards that, since we have a lot of other products that we want to build kind of based off this model. So we've turned down a few AMMs, but we'll probably be adding different AMMs and going like on a few L2s eventually. We're starting with mainnet and Arbitrum. So I think there is that potential. I think we're less keen on the order book based AMM model. So we may integrate with some of those, but it would likely be full range. And then, we're building our own AMM that would have a feeless DEX because we think that would potentially be a better way to scale some of these AMMs. So that's a product we want to build after. And then, I think I've talked about this in other podcasts, but essentially I think GammaSwap is going to end up being like a Frax where actually we build in multiple categories and they're all based on the GammaSwap model. So we have ideas for different things that would touch a lot of major categories in DeFi, and it's contingent on us being able to track liquidity.
With over 170 million TVL cross-chain, the multi-chain liquid staking protocol Stader Labs is just about to launch the ETH liquid staking token ETHX. ETHX will give you the best of decentralized staking and DeFi yields. What's more is that anyone can permissionlessly run an ETHX node with just a 4 ETH bond. To get more alpha on the ETHX launch, go to staderlabs.com/Ethereum. Your research, and I think lots of others' research has pointed out that if you're in an LP and you're in a volatile market, which crypto is a pretty volatile market, that the compensation of trading fees isn't always enough. Again, I want to caveat all of this with the fact that this is really new. Obviously, this needs to be stress tested in the markets, and we're excited to watch that go live. But I could actually see folks who are, let's say, using something like portals, which is like a one-click deposit into an LP. I could see like the portal basically depositing you into the correct pool on something like GammaSwap in the future so that you can earn that increased yield.
Yeah, I think if we end up getting some liquidity, aggregators will be interesting because now maybe you'll have aggregators based on if it's like pool built on top of another pool. Because normally if you're considering the risk between like Uniswap and SushiSwap, it's not just like based on the APY, right? It could be like, okay, what's this AMM? There's different, maybe if there's weighting too, that affects like your returns. But if it's literally in the same end state smart contract, it's an actual arbitrage between like the yields there. So I think there's really interesting things with aggregators, swap aggregators, and then for our own purposes too, like the borrowing, right? Like right now, when you borrow, you're going to select the pool you want to borrow from, but people who want to trade perps, they don't really care what pool they're borrowing from. They just want to borrow. They want to trade the volatility on some token. And so we could even build our own aggregator that's, basically giving them the best rate on the different APYs from these different AMMs and maybe even our own AMM, and just aggregates that borrowing across all these various AMMs.
Devin, are you able to tell us anything about a future GammaSwap token, like anything about the function or utility that we would expect out of a token?
I would say, so we raised our seed and we were lucky to have a few of the GMX core contributors join us. CoinFlip, who leads a lot of like the partnerships and communications, and then Quad, he's done a lot of the like economic modeling for GMX, and so he's been helping us like optimize our spread and a lot of like the interest rate aspects of our platform, and then the tokenomics as well. So I would say there's going to be some things that might be similar to something like a GMX. There's going to be some things that we're doing that are kind of completely novel and unique, and we hope, if that succeeds, that other projects will be using this model as well. Because I think a big thing, one with GammaSwap as a way to compensate LPs better for their volatility, and certain aspects of our tokenomics is a way to not, have highly inflationary, token incentives to compensate things, and have more kind of like, it's like, a meme kind of like right now, but like real yield, but like actually compensating people for their own risks, and then projects, have more basically long-term, runway and survivability if they have sustainable tokenomics. So that's what we've been aiming for, GammaSwap as a product, and then also our own tokenomics. So yeah, I'd say there's some things we're being inspired by from projects in the space, and there's other things that, we feel like will aid us, and we're creating from scratch.
That's awesome. I'm excited to read more up on the tokenomics whenever that comes out, and I'm just a nerd like that. So I want to talk just a bit about this closed beta. Went live March 17th, I believe. What's been the experience so far? Like, any big lessons learned?
Yeah, so the closed beta, we launched with basically our new UI, and we wanted to have like a smaller community, basically kind of like look at that and then make sure everything was good, and then also help with some of the bugs before we launched our open beta. So I think everything's been going well. I think people now can feel like, maybe, I don't exactly understand the mechanism behind GammaSwap, but I kind of know how to like trade this, and it seems like something I could use. And I think everyone maybe should do research on the product, and we're actually planning in some of our designs. Maybe it was available today for people to see, but we actually include some of that information below the actual product that they're going to use. But also, it's good if people can research a little bit, especially if it's a project that's been around for a while, and then feel comfortable using it, kind of off the bat. And so I feel like our product is much better for that. We might have an advanced version later, but this is a much more retail-friendly product, which is, I think, ultimately what we're trying to do is blockchain's like for the people, so we should increase the usage of people and users, and another metric to look at besides just like TVL. So now it's just about adding so charting is something we didn't have in our protocol, so we're charting it based on like price. I think there's things that make more sense to maybe chart off on the future that would be more informative to traders, but charting price is kind of the most simple. So we're starting with that. We'll launch our open beta in about a week, hopefully, and then we'll have a trading competition with a few, a lot of the main projects on Arbitrum and some outside of it sponsoring it with some of our friends at Risk Finance, which is an options AMM on Arbitrum. That should last about a month, and then hopefully we should be able to launch mainnet after that. We added some new things to our smart contract, so we're just waiting to get that audited. But after the trading competition, our UI should be mostly there.
I have definitely felt the pain of impermanent loss, and I think that underlying premise of LP rewards sometimes have saved me from that, but I'd give anything to have had GammaSwap in the past few years with some of my experiences with LPs.
Right. It's like, maybe I'm confident about a project, but there's no way for me to hedge because, I can buy perp, but one, the delta is not in line with the AMM, and it's only token supported by an Oracle, so there's no way to hedge. And I think, just generally, if we have more insurance, like there's been some, products doing smart contract insurance, but insurance on like actually providing liquidity for these new projects, I mean, that makes the most sense, right? Like maybe you're really bullish on something, but it's anonymous developer, or it's just new. Like you don't know exactly how the tokenomics are going to fare. Like, okay, I'm bullish, but I'm going to withdraw a little bit of liquidity just to hedge, just in case. And I think, or just markets that are volatile. And then, also, if you can get compensated by those people speculating, because that's what a lot of people like to do on the altcoins, even if it's just spot, now they can speculate with leverage. Okay, now I can earn actually maybe like a really good yield if there's enough speculators on this token as an LP.
Well, Devin, thanks so much for your time. I think this is a great place for us to wrap. And I want to remind listeners, you can learn more about GammaSwap by going to GammaSwap.com. You should follow GammaSwap Labs on Twitter. That's the handle, GammaSwap Labs. You can follow Devin here at 0xDevinG on Twitter as well. Devin, anything else you want to share before we go, or any recommendations for getting involved in GammaSwap?
No, I would just say, if you, we're going to start a newsletter again. We had a waiting list before. but Twitter is probably the best way, Twitter and Discord, to stay up to date. And then hopefully we'll have more ways to stay up to date in the future with newsletters and other things. So yeah, I would say if you're interested in what we're building and want to use the open beta or mainnet when it comes out, yeah, just follow us for those announcements. We'll have, a lot of announcements coming in the next few months.
Thanks everyone for tuning in. If you're a talented builder like Devin, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please subscribe at our link tree at edge_pod.